Welcome and thank you everyone for joining our webinar today. My name is Richa Dubey and I'm the Director of Revenue Product Strategy here at Workday. Before we get started, I'd just like to cover off on a few housekeeping items. If you're having any technical issues, please click on the help icon at the bottom of the ON24 console. We have technical support on standby if you're having any issues. Be sure to access our additional resources within the console and follow the live conversation on Twitter as well. If you have any questions, please enter it into the Q&A widget in the console, and we will do our best to address any questions at the end of the session or as follow-ups if we can't cover them today. Everyone will receive an email after the event with the recording. So welcome. Our agenda for today, so during this session today, we'll cover the new revenue recognition rules, what they mean at a high level for sure. We'll hear some best practices to adopt and transition to the new standards. We have two experts on the call that will guide us through that. Ways in which to make the transition simple. So again, a practical way of how to sort of go through the transition process. And then, of course, Q&A toward the end. So that's our agenda. I'd like to introduce our speakers for today. First off, we have Tammy Kuna. Tammy is the Senior Director of Compliance and Reporting for Revenue at JDA Software. She brings more than 15 years of accounting experience in a variety of industries, including software, manufacturing, service, and retail. Her background includes software revenue recognition, financial statements analysis, and of course, as a leader, staff development and management, project accounting, and change implementation. Very key as we go through this process of transition. Most recently, Tammy has been leading JDA's new RevRec standards uptake initiative, which we'll hear quite a bit about. That's going to be a big focus on today's call as Tammy shares what they're doing at JDA. Brian Sommer, who's the CEO of TechVentive, is our second speaker for today. For over 30 years, Brian has been advising the world's largest firms on strategy, change, process, many technology initiatives. He's assisted over 100 of the Fortune 500 on financial software selections and continues to advise a wide variety of array of high technology firms globally. He was a senior partner at Accenture with leadership roles in their software intelligence, HCM, finance, and performance management groups. Brian also led global finance and HR shared service projects and was a quality assurance partner on large implementation projects globally. So we have two fantastic speakers. Welcome, Tammy and Brian. We really look forward to your perspectives on this very important topic today.
Thanks.
Thank you.
Awesome. So with that, let's get started with our first polling question. We would really like to understand what organizations are doing today and kick off the discussion with this particular question. The question is, how is your firm meeting RevRec requirements today? Simply reply with a response that most accurately reflects your current approach. Are you using mostly spreadsheets? Are you using financial accounting or revenue management application software product? Is it a mix of several tools or approaches, or if this is not applicable to you? We'll have 30 seconds for the audience to respond to this question. While we wait, I guess, Brian, I have a question for you. Curious to know what you are seeing in the market. How are organizations sort of doing this today? You have a pretty wide exposure to several different organizations, so would like to hear from you on this.
Well, I guess I'll play Karnak the Magnificent and predict the answer here. I think we're probably going to find a lot of them are using spreadsheets right now. Some of the revenue management modules that a lot of vendors have are fairly new and not as commonplace as you would think in the market. That's changing. So I'm guessing we're probably going to hear a lot more spreadsheet stuff, but I think everybody's figuring out that's not going to be a viable approach going forward. But I am curious to see what the poll results are going to say.
Tammy, any comments from you?
Yeah, I agree. I think we're accountants. Most of us are accountants that are dealing with this. We're comfortable with spreadsheets, and so we tend to, that's what we use.
Awesome. Okay, let's see what we see. Okay.
Wow.
So yeah, spreadsheets.
Wow.
Mix of several tools and approaches. I think spreadsheets definitely number 2 leader, and I'm assuming people are using many other things. Unsure, not applicable. Okay, that's another interesting one. Okay, so let's move forward. So good perspective. I think so. Speaking on the new rules, let's talk about this. So I wanted to get a big picture of what you're seeing. So Tammy, we'll first start off with you.
Yes. So this is why we're here. So this slide tells you in 2014, the Financial Accounting Standards Board and the International Accounting Standards Board issued their final standard on revenue recognition. This was a joint effort to create a standard that would be followed globally. The board believed that the new standard would streamline and improve consistency of the requirements, kind of give a comparability of practices, and to make disclosures globally more useful. So this project not only included revenue, but also new leasing accounting as well. And I bring this up because many companies are considering adopting them together, which they're calling the Big Bang approach. But if you are considering this, I would recommend that you read the rules and the requirements to adopt together, because there are some specifics to this of why you may not want to or cannot because of the requirements. So, but today's webcast, obviously, we're going to be focusing on the new revenue standards. Brian, would you like to add some commentary to this slide?
Thanks. Yes. So I think one of the most important things is to understand what kinds of companies are going to be most impacted by these changes. If you're a firm who bundles things together into a single contract, things like products and services and or warranties, and you pay commissions on sales, particularly if those commissions fall, maybe you pay a commission up front, but the service or product is delivered over a long period of time. If you are like a cable TV company or a cell phone company and you let people make mid-term contract changes, and I could go on and on, there's just a pile of different companies whose business practices are going to require them to have a more finessed kind of view of how they're going to do revenue recognition accounting going forward. If you think it doesn't apply to you, that I would certainly get that checked out with your external auditors, because the numbers of situations where the new rules apply, I think, is actually quite large. But before we get too far down that path, Timmy, why don't you kind of step us through the 5 steps, I guess, required on the 5 core principles on how the new rules are going to be applied?
Yep, absolutely. Thank you, Brian. So as many of you are aware, or should be aware, these are the new 5 steps of revenue recognition. If for some reason you're not aware, I would suggest going to the FASB website and reading through each step carefully. And the reason why I say read through carefully is at first glance, you may think that these do not appear bad. Reading through them, you might even think that they're easy to understand, but I can tell you from my perspective, in the software business, they're not. For example, if you just take step 1, this is not just having a contract in hand, with all the terms and all the conditions appropriately documented. It's more than just identifying a contract with a customer. For example, now you have to establish collectability. So in today's world, if we believe it is uncollectible, we would just put them on cash basis, or we'd adjust our reserves appropriately. But in tomorrow's world, we would not be able to pass step 1, and therefore not be able to even book a contract into the system if you don't have collectability or a probability of collectability. So just this one step, you'll need to assess, your business processes for cash. You'll have to look at your reserve process and what is the definition now of your contract. So kind of things to think about is, how will you handle it if you have no historical payments? How will your reserves change? How will you book the deal into your system if it's deemed not to be a contract? So, I would highly recommend taking each one of these steps and then applying it to your company because, of course, every company is different. We're a software company, but we're highly affected by many of these steps. And again, I just gave you an example of one of these steps, but there are many attributes in each one of these steps that you need to look at. So I would recommend that. So, Brian, what are your thoughts?
Well, let's just stay on that first one for a moment more. I think one of the biggest challenges a lot of companies are going to find is maybe they've had a way of booking revenue recognition in the past, and they have forgotten about where those original source documents are. Or maybe they're a big global multinational company that a contract was signed at headquarters in, I don't care, like the UK, but you're trying to deal with revenue coming out of the United States. And you've got to get your hands on that original source document, and that could be real difficult to do, particularly for companies that have multi-year agreements, multi-part agreements, and agreements that may cover multiple countries. So just finding and getting your hands on those documents could be really difficult. I know I probably contributed to a lot of RevRec problems for a lot of technology companies because when I negotiate contracts for clients, I generally come in with our paper, not the vendor's paper, which you probably at JDA, you hate people like me for doing that because that's going to create additional work even on accounting because you're going to have to go through all of those unique contracts and all the unique terms and conditions to figure out what the implication is going to be from an accounting perspective going forward. Anyway, the last thing I would tell you is getting your hands on those documents. The other real big wrinkle is if your firm does a lot of merger and acquisition and or divestiture kind of work, then you don't know where some of those original documents are because they may have belonged to a company that either that didn't do a good job of keeping its documents in order when you bought them or before you bought them. So just that first step may not be the little baby step you think it's going to be. It could be quite big. Tammy?
Yeah, great perspective, both of you. So, Tammy, one question, since you mentioned collectability, specifically at JDA, have you determined what sort of process will you follow to establish customer collectability? Did you already have a process, or what's going to be your approach?
Yeah, so we actually are now still defining what that process is going to be. I mean, we know that we are going to use historical for existing clients, and for the regions we now consider a risk. We'll definitely be using historical, which we kind of do that now, even on our credit risk. How much do we need to reserve based on, past historical information. But for brand new clients or for new regions that we go into business with, because we are a global company, we are still determining what our process is going to be.
Okay, thank you for that.
Yeah. The next slide. So these are the upcoming deadlines for adopting the new standard. So if you're a calendar year public company, then you'll need to start reporting under the new standard by January 1st, 2018. And if you're a private company, you get an actual additional year unless you decide to early adopt. As we're fast approaching, there have been many steps you'll need to take. And in the next slides, we'll be discussing that, how I got started here, at JDA. But Rich, I believe you would like to clarify some non-calendar year customers. You've had received some questions or many questions over this.
Sure, thanks. Yeah, we typically get questions from customers in terms of when they need to be on the new standard. So, just to highlight that if you're a public company, if your fiscal year is Jan through December, then really Jan 1st, 2018 is when you need to be, that's your deadline. You need to be on the new standards. However, if you have, let's say July through June, that's your fiscal year, then your dates would be July 1st, 2018. So really start of your fiscal year 19. So you have a little bit more additional time. Yes, it is 6 more months, but there's a lot of work to be done, as you'll see going forward. So just wanted to clarify that because we do get that question, quite a bit. When do I have to be on the new GAAP? So depending on your fiscal year, that's how it would align. For private companies, just add another year, as Tammy mentioned. So I guess question for Brian, I know this was a very often asked question last year, and I think the answer is sealed at this point, but do we really see any of these dates moving from here on?
Nope. I don't see any kind of movement forthcoming on that at this time, and I would not advise anyone to bet on a delay coming. That could be a very dangerous thing to do.
Yeah.
Yeah, and the TRG just in their last meeting, they stated that they're not planning on meeting again unless there's further clarification. So to me, that means green light, go. And so that's what I'm going to talk to you about. So this slide actually has a decision that should be made kind of up front in your transition, I believe. So what transition method will your company select? So there's two methods. There's full and there's modified. There's a lot of different requirements for these, but at a high level, for full, you'll need to restate all years that are presented as if they were under the new standard. For modified, you would only be applying the new standard to the contracts that are not completed at the effective date and record that accumulation catch-up to retained earnings in the transition year. So this slide represents information that I presented actually to our CFO and our audit committee. So what I did was I took a contract that we had signed in May 2016. It was a contract that had an undelivered element. So we're recognizing that revenue over 5 years. So this contract will be affected by the new standard, and it doesn't matter actually which transition method we use. So that's why I thought it would be a good example to show the CFO and to the board how this would affect this contract. So what I presented was I showed them what the contract is under current GAAP, so we have today. Then I showed them what it would look like under the modified approach, and then what it would look like under the full approach. So this gave them a glimpse into how the new standard would change the outcome of the balance sheet and the income statement, as well as how much work would be involved in reviewing each contract. And that kind of comes out with some of the pros and the cons on here. I mean, for example, if we transition using the full, the contracts that need to be reviewed would be substantially more as compared to modified. And although, then you look at the modified and the disclosure requirements are going to be much more than the full. So you have to kind of weigh out your pros and your cons. But no matter which method you choose, there's a lot of work to be done, no doubt. And even, Brian had mentioned earlier, one of the cons was, he talked about contracts, being able to find old contracts. Well, we have that here where we have done a merger and acquisition, and some of those contracts may be difficult for us to find. So I actually have that on my con approach under the full retrospective. So I thought that this would be, using an example would be a good way to show our CFO and to the audit committee, really what type of effect this would have. So, but our concerns, or the CFO's concerns, that what he had was kind of questions he posed back to me is, what if we have a change in ownership? What does that look like? What if we refinance our debt? So our CFO felt like we would need to provide comparative financials in both of those situations, and it may be more difficult to show using the modified approach. So along with some other facts, we actually decided here at JDA that we're going to use the full was the best option for JDA, but I wouldn't throw out using the modified approach. So what I would say is I'd recommend you kind of figure out who the users of your financials are. So what information are they using? They maybe review your future business plans. This way your company can kind of make the best decision based on the facts, as your concerns and your needs obviously can be different than what JDAs are. So
Yeah.
that's, yeah. So Richard, do we have a polling question next?
Yeah, just before we move to that, I think the one question I had for you was, you mentioned disclosure reporting, overall being much more in the modified approach. Can you elaborate just a little bit on that? What sort of has been your discovery as you went through this process? What would you need to add in terms of disclosures if you did pick the modified approach?
Yeah, so yes, modified approach would require companies adopting it to include incremental disclosures, so more disclosures than you would for the full approach. And what those would be is, so you would have to disclose the amount of which each financial statement line item is affected in the current reported period. And what that means, what people are calling that is dual reporting. So you would have to report on what it would be current GAAP and what it would be for modified, and you'd actually have to tell them also, not only giving them the quantitative, qualitative, you also have to give them the reasons for these changes. So that's why it's going to be quite a bit of work. But again, it's quite a bit of work in the transition year, different than full. Obviously, you're going to do a restatement, so you're going to be able to show that in your financial statement, which would be more work starting now or months ago.
Okay. Thanks for that. Okay, yes, and now on to another polling question with that insightful information that Tammy provided. So given all the talk we have about, which methodology, would like to poll the audience to see, which approach are you planning on taking, full, modified, or undecided. So please go ahead and take 30 seconds to respond to this question. Brian, I guess question for you, do you see, from all your conversations and what you're seeing out there, are organizations leading one way or the other in terms of approach?
Well, I'll make a brave prediction here. I'm going to predict we're going to have a lot of undecided at the moment, and the reason I say that is a financial software company released some survey results this morning that showed, let's see, it was 54% of financial accounting groups still haven't even begun the assessment phase at the very beginning of getting ready to implement new RevRec requirements. So if you haven't even done the assessment, I don't know how you could have chosen whether you're going to go full or modified at this point in time. But I'll defer to the folks on the call. Why don't we see what the survey results say, and we'll go from there.
Okay, yeah. So we have majority undecided. Yeah.
That's
so I think
quite a majority, yeah.
Yeah. Yeah, I think since last year we've seen in certain types of polls like this, people were initially thinking that modified might be the simpler approach, so we would see more of the modified, and then since last year it's been sort of flipping over a little bit. Kind of a lot of it is based on the reasons that Tammy also said. So, but yeah, undecided is quite a bit. So yeah, I think the time is now for folks to really get going on this, I think, is the message we've been definitely giving out as far as Workday is concerned, and I think from practitioner standpoint, that's also what we're hearing. Okay, next slide.
Okay, thank you, Richard. So also as part of my presentation to the CFO and Audit Committee, I put together a high-level transition and implementation plan. So first we needed to identify a project manager. This person, I wanted 100% dedicated to the project. I cannot, stress enough how much time this new standard takes to implement. And after reading and on the requirements that, I figured we needed for our company, I would actually need at least one person, 100%, just to help guide the project, just to be the project manager. So we also, I think for companies you have to determine, do you even have that bandwidth with your current staff? And most people do not. So we did have to make some changes and hire someone else to backfill for that person. But you may want to also evaluate, how much help you need from a third party. And I wouldn't say if you need it, I'd say how much do you need. So that was also something that we did in Q2 of this year. So now we're moving on and we're into Q3, and we have established our cross-functional team. You can see from the list below, which includes almost all departments at JDA. But as a standard affects almost all departments, you need to start communicating with them so that they understand the impact. We also have our steering committee, which is the executive team here at JDA. And as I spoke earlier, I mean, many of these were on in the audit committee and with the CFO meeting that I've already had. So through this process, we've also been meeting frequently with our auditors, and it's something that even more recently more than before, just because now we're kind of coming up and making determinations, and we want to make sure that they're on board with our decisions. So we're now in the process of evaluating all of our policies and business practices. As I spoke earlier, in looking at just that step one, we have 3 different business processes that we have to go through. So we're actually doing that now. We're also working on our system evaluation. So I've been working with Workday. I've been working with Richa and the product development team there to evaluate the technology and how to actually adopt it to this new standard. So we will be using Workday as our revenue management system and to help us transition to this new standard. It's something, for us, I feel like we're lucky. We went live January 2016 of this year, and all of our contracts are sitting, our current contracts are sitting in there. So we'll be able to use this tool. But again, going back to what we were talking about in that polling question, I would say if you haven't got started, get started. Appoint somebody designated to the team. If you can do a project lead, great. Make sure you have that cross-functional team. I think it's important. They need to understand how this is going to affect them. Plan to present to your audit committee and your CFO, or the users of your financials, which could be somebody different. Give them a high level of the standard. Discuss the modified versus the full approach. And use an example. I thought that was the easiest way for me to explain it and to show them what the effects are. So, grab an example, not too difficult, but not, obviously too simple, so they will be able to understand how that's going to affect you. And then you should be doing like a high level of how it will affect your company, especially on the revenue side, which, I have on the next slide, and I'll be giving you some examples of how I did this. But before I move to that next slide, Brian, I believe you have some comments.
Yeah, I'd like to everyone on the call, I would just say this is probably, I think, Tammy's best slide, and that's because it kind of shows the magnitude of the effort all in one picture. And if there's one picture or something you'd want to copy and share a version of it with your leadership group in your firm, this is it. But let's take it a little bit further. Another study I was reading this morning was talking about how finance accounting organizations, most people in them are working 50-hour weeks very consistently, and they don't have time to do a whole lot of anything. So if time is already a constraint, I can guarantee you this isn't going to lessen your time in the short term. It's going to, I think, seriously compound some of your time crunch kind of problems. And you have a responsibility, I think, to the leadership of your firm to let them know that there is a lot of effort involved on this, and you're going to need a lot of help, at least temporarily. And point out to them, granted they already know this probably, but remind them maybe that you've still got month-end closes, quarter closes, year-end audits, and all the other stuff that just chokes up the accounting calendar so tight. There just isn't a lot of bandwidth. And the next thing you want to remind them is go through these different chevrons, kind of the way like Tammy was doing, but I would emphasize just how big some of these efforts are. If you have to implement new software, which is down on the bottom row, that's generally not going to be like one part-time person for a couple of weeks. It's probably going to take a whole lot more effort and energy than that. The other thing I would tell you is some of these process points, and these are policy changes that are in the middle row, can be quite significant. some firms are having to make some tough policy changes involving things like commissions, and or how they handle these multi-part contracts. If they're, let's say, they decide maybe we don't want to allow customers to make a mid-term contract change. So if you're going to have those kind of possible policy changes, you're going to have a lot of conversation with non-financial members of your company and part of the operational side of the house. You're going to have to do a lot of communicating with them. They're not going to understand why they have to go through these changes. I know salespeople get real touchy when you start dealing with their commissions because you affect their livelihood. Don't underestimate the people into these kind of changes and how they can impact your firm. So again, I think this is a critical discussion slide, and probably it was worth the admission to the webinar just to see that alone. Tammy?
Thanks. Thank you. Thank you for the compliment. So this is what I was talking about earlier, where I said you need to kind of give a high level of how it will affect the revenue of your company. So we're, here at JDA, we're a software company. So what I did is I took our deferred revenue and I put them into buckets as to why they were deferred. So for us, our largest reasons why they're deferred is for linkage due to unsigned contracts or SOWs, and then the other is for non-VISO, so VISO deferrals. So all others were much smaller, but I also wanted to give the audit committee and the CFO be able to understand what will happen in these scenarios as well. Because as even Brian stated, there's always different business process. Salespeople want to sell things differently. So might think, hey, if I can give this person some extended payment terms for this contract to get the contract, well, there's implications for your revenue. So even if maybe you don't have these in your buckets, maybe there's still situations that that your company may be thinking of, and you'll want to let them know how it will affect, the new standards will affect it. So if you look at this for us, for linkage, due to unsigned contracts, that one won't change for us. The revenue will still be deferred. But then if you look at non-VISO compliance, we will no longer be deferring that for the lack of VISO. So the revenue will be accelerated. Of course, you have to remember you still have to establish BSP. So there's still other stipulations in there, not just, okay, great, non-VISO compliant, I can just throw it out the window. There's actually more work to be done to ensure that you can accelerate this revenue. Cash basis of accounting is going away. I discussed that earlier. We will be accelerating the amount we consider probable to collect. But again, going back, you have to figure out what your business process is going to be. How are you going to consider your collection, your collectability of those? Extended payment terms. So if they're over 365 days, you will be able to accelerate the revenue, although you'll need to carve out a portion for interest expense. Future functionality. You'll now need to be able to accelerate all but the standalone, I should say. But again, to reiterate, you're going to have to come up with your performance obligations as well as the transaction price for those. So the work that you need to do to be able to ensure that this revenue can be accelerated. Again, I want to, just say that, and to comment to the board, if this is not something that, okay, now there's no work to be done, we're just going to accelerate revenue. So you want to make sure that you explain these thoroughly as well. So Brian, Rich, I don't know if you have can make any comments.
Yeah, so as we look at this list, right, this is pretty important stuff here, and these are really strategic decisions because you're accelerating so much revenue up front. In each of these cases, your expected impact for JDA at least is that you're accelerating revenue, and I'm guessing that's probably applicable to several organizations. So I'm curious, how did your team and your executive management react to this impact of accelerated revenue? Because it's going to impact not just the current year or the year you finally transition, but even the following years, right? It is a pretty strategic decision to kind of do this. So comments on that?
Yeah. Well, I mean, anytime you tell a CFO or board you get to accelerate revenue, they're all in for it. They're like, yeah. But, and I think that's why I caution people to explain that it's not just an acceleration of revenue. There are other things that need to be done to ensure that you can accelerate that revenue. But, you know, it will look different. It's going to feel different. So it'll take them a little bit of time. I think budgeting is going to be difficult because they're used to, I mean, we've had years with these revenue rules that we have today. So for these new RevRec rules and you're going to accelerate revenue that you haven't accelerated before, I think it's going to be difficult for them to budget, and also a lot of, you know, it's a lot of work also in the transition year that you're doing it. And depending on your method that you choose, deferred revenue will be flushed out, and you're never really going to hit a line, you know, a revenue line on the income statement. So these are all things that I think maybe even like a next step to explain to them. Especially when we get closer, I think that's something that they're going to have to understand, because I think at first glance, you know, the only thing that they're hearing is accelerated revenue. So I agree with you. I think we're going to have to also help them understand what that means and what that means for years to come, not just in our transition year.
Thanks. Yeah.
So as I spoke about earlier, Workday, our JDA implemented Workday Financials in January 2016. So, you know, for us, all of our revenue and all our contracts are in Workday. So we have also integrated a quote-to-cash process with Workday. We were already using Salesforce. So what we did is we took our opportunities. They go from Salesforce, become agreements in Aptus, and then are integrated into the billing and revenue tools within Workday. So, you know, for JDA, we're able to use the functionality in Workday to assess our contracts. We can identify our MEA and linked contracts. We can identify our deferred revenue and then use these in our scenario tool for modeling. So there was also other values that we've realized as noted. So, for example, before Workday, we were limited to the information we had access to. So with Workday, we have more visibility, and it's even more easily accessible. So which will, you know, become even more important as we transition to this new standard. But we also, again, our contract entry system, with us using the quote to cash, it's really decreased our time to get the contracts in, and also to run revenue. I mean, it used to take us 2 to 5 hours, but we'd have to do it even after non-business hours. And today it takes about 25 minutes, and we do it in the middle of the day during close when everybody's booking journal entries. So that's been a huge win for us here at JDA. So Rich and I, we've been working a lot together. I don't know if there's anything that I may have missed or something that you would like to add.
No, I think you covered, a lot of the key points. I think the first part of integrated quote to cash, I think that's very critical, that you need access to all the transaction data real time as you're looking at your contracts, as you're doing that assessment. So I think I agree that's a big value add. And also revenue recognition is part of your part of that integrated quote to cash. It's not a disjoint process. I think that is also something that Workday really recommends, and that's really the foundation for our solution. So I'm really happy to see that actually helped the process at JDA. So that's all I would like to add there.
Mm-hmm. Thank you.
Awesome. So, that was fantastic information from really, a revenue manager's and a, practitioner standpoint. Tammy, really thank you for covering all that, and Brian for all that commentary there. What I wanted to just cover is, what is Workday recommending as far as transition to the new revenue recognition standards? So we're really recommending a 3-phase approach, and this will resonate a lot with what Tammy already kind of talked about, but this is more from a product standpoint. So when you're in your assessment phase, which I'm assuming a lot of organizations here today are, really, what we mean there is review and assess to do that, the impact of the new standards, A key part of this would involve a detailed review of all your active contracts that you have today that are potentially impacted by the new requirements. So, that may be a system review, but you really need to look at it holistically. And then what we have within the system is something, this is a term, it's a new term called contract sets, which will allow you to group your contracts if you've already migrated them into Workday into groups or contract sets, which with common characteristics. And then you can take a look at those contract sets and really talk about the impact, such as transaction pricing, revenue allocation, etc. So by defining the contract sets in this assessment phase, you can quickly identify, what's the impact at a very high level. It's a lot of review and looking at your current data, but we give you tools to sort of make that easy. So once you've done that overall assessment, the next thing you want to do is really look at the model policy changes. And what we are providing are tools to allow you to model those policy changes. So you can configure revenue rules based on the new standards. We already have a foundation today that will support the current revenue rules, but with the way the scenario tool and other tools within Workday work, you can configure new revenue rules based on the new standards. Once you've done that, you can create something called an alternate contract for those with potential impact. So you already had set up the contract sets early, but then you can actually create alternate contracts in your main system, in your transaction system. And then this is a play area for you. So let's say you come up with 5 sets of contracts, depending on your revenue streams, depending on how you sell those products. You can then create alternate contracts one by one if those are big contracts that you really want to look at, or in mass as well. And then you can run what-if scenarios on those alternate contracts to really assess the total impact of the new standards on this, historical data and even, current contracts that are alive. So you have those tools with you. The alternate contract, which is new, it was released in 2017, and the what-if scenario tool, which was out there in 26, and then more enhancements in 27. Both of those tools will really allow you to both do the assessment, model the policy changes. And then once you sort of know that based on step 2 that here's your big impact, our approach is then you should be able to sort of book the delta or the impact of those changes automatically. So, these adjustments are reflected in real time across the financial statements and disclosures for you to be able to meet the reporting requirements. We would generate the accounting entries automatically once you've finished your what-if scenario, and then that would be available to you as you're doing the reporting. The alternate contracts with Workday really allow you to create and maintain, separate sets of books. And then you can also run all of this retroactively during the dual reporting transition period so that you can really meet that dual reporting requirement. You can do it retroactively. So if you're starting today, the scenario tool will really allow you, if you had a contract starting, let's say, early January 2016, you'll be able to go and look at revenue impacts all the way from January 2016 to, let's say, now. If there is a difference in each of the periods as far as revenue is concerned, you'd be able to first view it and then decide that, yes, this is the approach I want to take, and then actually book that revenue. So that's the overall approach that we are recommending. There's a lot of material out there on community and other documentation that you should definitely be able to look at. We've given a lot of detail, step-by-step directions on how to use alternate contracts, how to use scenario tools to sort of start this process. So definitely review that, and then reach out to us as you start this process. So we're definitely looking forward to hearing.
Hey, Risha, Brian.
Sure.
If I could, let me just throw a little color on that assess piece. One of the things that's kind of surprised me a few months back was listening to some companies talk about their experience with Assess, and they would get a little hip and wise to what the new RevRec requirements were. They might have some meetings with their external auditors or some other advisors, and then they go out to do an initial, I'll call it a survey or assessment with one of their plants or divisions or business units, what have you. And they start going through contracts, and that causes them to learn a whole new list of questions they have to go back and get answers on. So there's a cycle back with the experts. And they go back and they test it out, and they figure out, we may have to make some changes to some policy things or contracting practices, whatever. And they might think that they're done, and then they find out, well, wait a minute, now we'll go try and apply this at another division or plant or an acquired entity or whatever, and they realize, like, wow, they do business differently over here. They have a different set of contracting standards. They have different pricing mechanisms and commission structures. And it goes on and on and on. My point in bringing this up is that the Assess deal sounds like, if you're not paying too close attention, it sounds like, it's just get a little hip about how these new accounting rules are going to impact some contracts. But trust me, there's a lot of work sitting there in the Assess phase, and don't underestimate how big that piece is going to be. Anyway, that's all.
No, absolutely. I think based on everything Tammy has said and what you are reiterating, I think that is very critical. So, and we're seeing that that's where a lot of our customers are today. They're looking at those historical contracts, to really determine, what's the impact. So that's a big chunk of the work right there. So the second thing I wanted to definitely point out is that we want to highlight that, I talked about the transition, but before you even think about that, I think what I do want to highlight is from a Workday product perspective, we fully support the revenue recognition, but also the entire contract to cash workflow. So all the way from, contract creation to approvals to billing, revenue recognition, amendment, renewals, and then all of that built on our always-on audit capabilities. Typically what we see is, many of our customers create the contract within Workday, but a lot of them, like what JDA has done, have a CRM or some other system up front where the opportunity is booked, and then they bring that data into Workday, and the contract is created that. So then billing and revenue recognition can progress from there. So, this is sort of the full flow from a contract to renewal perspective. There is customer accounts, of course, available, but this is what our complete revenue solution allows you to do. So if you are considering an ERP and are evaluating your options, this is our solution where revenue recognition is really part of a unified revenue solution. It's not a separate or a bolt-on solution. You'll probably see that in a lot of other cases, but our philosophy and our architecture is to allow revenue managers to really do those deep revenue recognition, allocations, fair value analysis, those types of capabilities right within the contract to cash flow. So it makes things a lot easier because you're not having to take invoicing data out of Workday into another system or, into another module, so to speak, where you would be doing revenue allocation and revenue recognition. All your trigger points, billing, whether it is a contract modification or whether it is a billing event or any other type of event, it's all contained within the Workday revenue solution. So you're just having to do a lot less integration work in that case. Most of your triggers are right within your contract to cash. So it's just a matter of setting up revenue recognition rules, setting up your fair value pricing, and then right from within the contract, you're able to do what you need to do. So that's, from where we stand, that's a really big value add. You're already going to be doing a lot of work as far as, assessment and other things. From a system standpoint, if we can give you a unified contract to cash that will allow you to really do the core rev rec instead of worrying about integration, that's kind of our goal here. So that's what I wanted to point out. And so I'm going to move to a polling question next. Oh, sorry, something happened here. Okay, no, hang on about that. Yeah. So this is our polling question. Based on where you are today, how ready is your firm in implementing the new RevRec deadlines? This is really for us to understand, how things look. So are you still in the early assessment phase? Have you already completed assessment for one or more of your plans, divisions? Are you discussing adjustments to company policies already, commissions, contract terms, etc.? Are you implementing new or already looking at updated software? Are you looking at existing contracts, mapping them, grouping them? So just curious where you are and how detailed you are in your assessment phase. Brian, I think the one question that I have for you that we actually got in one of the Q&A is, and actually for you, Tammy, as well, a lot of organizations can do this internally, but who can companies and groups, revenue recognition organizations look for in terms of helping them in this assessment phase? Definitely a lot of internal, SMEs, like you would have that, but who's available outside in terms of assessment that folks can, get help from? Any comments on that?
Well, I'll weigh in on it. The obvious candidates are going to be accounting and tax firms, audit firms, because of their knowledge and familiarity with both the clients and with the new regs. The issue here, though, I think, is there's going to be, I believe, a rather acute shortage of this kind of talent going into next year. And I think your listeners ought to know that up front. That if you think you can just pick up the phone and get some extra help on a part-time basis or whatever to just come in and help you guys, I think you're going to see that resource getting very constrained in the very near term. Are you going to be able to get a lot of help from systems integrators? Well, I think they'll be able to help you get some software installed and or maybe convert some records over, but systems integrators generally they're knee-deep in technical skilled people. They may not have enough resources that are highly trained in the accounting world to be and the technical world to be able to deploy on all the different kind of projects that are going out there. Remember, this is in about 6 months time frame, all the public companies are going to have to be compliant with these new regulations, and then obviously all the private companies the next year. That's a lot of effort that's going to be expended in a very short amount of time, and I'm not necessarily convinced there's enough resources out there. But anyway, let's see what the poll results showed us, Risha.
Okay.
Wow.
Yeah. So a lot of early assessment going on. I guess that's a little higher than what I thought, but that's how it is. So yeah, I think just to add to what Brian said, right, as from a product standpoint, Workday has been continuously, from update 24, 25, 26, 27. We've updated a lot of our software to help with the transition to get onto the new standards. So from a product standpoint, we're definitely here to sort of talk to our customers and prospects to really show them what the system can do and help out with the new tools that have been released. So definitely reach out to us if you are still if you're looking for tools and, we have enough resources to sort of help understand the Workday solution. So, but yeah, as Brian said, I think if you're still in your early assessment phase and you think you would need help, then now is the time to really go out and look for that help from, tax, audit, and accounting firms. Okay, so I think I skipped one slide because it went out of order. I apologize. This one is Brian. So we were going to talk about, the key takeaways as the folks are looking and preparing for this transition. So wanted to have your take on this?
Well, in the interest of time, let's just say that whole top block is tied to that old adage, plan the work and work the plan. I think there's a lot of work that has to get done, and I think it's going to require everybody on the call is going to have to sit down and map out a detailed work plan on how they're going to move forward on this and find the resources and the time to make it happen. If you're going to be looking for some new solutions, I cannot emphasize enough that spreadsheets are not going to be the way to go. If you have any kind of modest volume now and going forward, you need to get a real revenue management solution, and preferably get one that's already integrated with the financial management suite that you already have, because the possibility for either latent data or data entry errors or integration errors can be very great. So try and get something as integrated as possible and look for some transition tools, if any, that will make it happen. I am aware of some products on the market where the new RevRec standards requires so many additional data fields that the old solutions cannot be upgraded in place and the data can't be instantly converted. It's going to be a greater effort for so check with your solution. I think Workday is migrating all their customers forward. One of the advantages of having a multi-tenant solution. Some of the other vendors may not have quite as elegant of an approach on this going forward. So those are my kind of parting thoughts on the transition.
Awesome. Thanks for that, Brian. So we can open up for QA. I think I see a couple of questions, so I'll see how many we can take. But before we do that, I think I definitely wanted to point out there is a white paper that's available for folks on this call. We will be sending this out along with the email that goes out. Pretty extensive discussion on this whole topic as far as, and also Workday's approach. So it is available for download. You can get details on this, and we will be sending it out from, as part of the email. So I think we have time for maybe one question here. So this one, it does have to deal a little bit with our approach to migration. So since most companies will be migrating to an automated tool for revenue, do we have a planned approach on how we will convert our contracts currently in motion with the new tool? So, I mentioned the alternate contract that is available to you today. So that's kind of the start from a migration perspective. You would look at your, you would create an alternate contract, do your modeling using that alternate contract, finish, pick your scenario that you want to go forward with. And then at the point of transition, that alternate contract actually becomes your, your new contract or go forward from Jan 2018 onwards. So I would definitely keep, we have more features around alternate contract, migration, and support for transition coming in 28 and even as, in 29. So definitely look for the roadmap, recordings that we put on community, but we'll be providing more details on that as we get closer to the updates. So, watch out for those. But alternate contract is going to be our main approach as far as, allowing you to transition. In terms of, if you're not on Workday already, so that, you're not on Workday, there is actually, there are new features coming that will allow you to bring in outside data where you can create a standalone alternate contract. So today you may not have a current customer contract in Workday, but you can actually create a standalone alternate contract and sort of do your modeling, do your scenario planning, and other things on that standalone contract, and then you can go ahead and treat that as your fully baked final contract once you go live in January 2018. So that's our approach. More to come as far as full roadmap, especially around transition and other things in 28 and 29. So definitely look out for that. And with that, I think we are at the top of the hour. So I would really like to thank both Tammy and Brian for joining us today and giving that fantastic practical approach to how folks should be looking at this, what they should be looking at, and sort of a good idea of the timeline and the process to follow as you start your assessment and your planning process. So hopefully that was helpful, and we'd love to get your feedback on any of the content. So thank you very much for joining today.